Hi and welcome to this episode with Artanjans, the founder and GP of Multiple Capital. My name is Alexander Kern. I'm the founder of X Capital and the managing partner of the German Euro Institute. Today we have Ertan here to speak about the venture capital space and particularly fund of funds. Ertan is really a pioneer in his field, but besides me now telling you about Ertan, I will ask Ertan, hey, can you tell us more about the VC space, how you ended up in that industry, which is a highly exciting asset class for most people. So how did you get there? What did you do? And how did you actually start Multiple Capital?
Sure. Thank you for the invite again, Alex. And yeah, let me tell you my story. I mean, I'm the founder of Multiple Capital. My name is Artanjans, as you mentioned. I have started Multiple 2018, and before that, I was working for a German family office and did more or less the same thing that I'm doing today at Multiple. The interesting part is I was hired 2012 in the family office to do direct investments, and then after 1 or 2 years, we just realized direct investments in direct investing in venture is much more difficult than people think. And so we changed our strategy into a fund of fund model. Typically, family offices start with fund investing and go into direct investing. So we started with direct investing and went into fund investing, and then realized that this is a much better fit for the kind of family office we were. What we have done then is really to start a pan-European venture capital portfolio of funds. And that was like what I consider the track record or the fund one in our track, which was very, very successful. And then in 2018, I left the family office, started Multiple Capital, and I'm deploying at the moment out of the second fund in Multiple Capital with the more or less exactly same strategy to invest in small, early stage funds across Europe.
You just mentioned like there were problems with the direct startup investments. Can you tell us a little bit more which problems you experienced? And on the other hand, which story you build up with your fund? Like what's your equity story? What are the problems you're essentially solving with your fund?
Yeah. So to your first question, direct investing means a lot of effort. It's not like selecting stocks and investing through a bank. It's really sourcing companies and then selecting the right companies out of a lot of startups. And venture is an uneven game when it comes to investing. So it's not like that you can invest in any startup and you will have a standard return. Some startups return a lot and most startups return nothing. And it's very difficult to get into these some startups, okay? One thing is you have to be diversified. You need more bets to have those outliers, winners in the portfolio. And second thing is that the better startups, the competition for the better startups is relatively high. So even if you recognize a good startup, you might be not having the opportunity to enter this startup at any stage, because better VCs or considered better branded VCs are looking for an investment. And if you're a founder, you will always choose a good branded VC because it will help you more. So that's one of the reasons why direct investing is difficult. And for many investors, also the idea of losing assets is they don't feel comfortable around it. So if you have a portfolio of 20 companies in startups, you have to feel comfortable about it that you lose probably 10 to 15 out of them, okay? And many investors don't feel comfortable about that. So our strategy or our equity story is to make it, we call it to democratize access to a diversified startup portfolio. Building a diversified startup portfolio is in the VC ecosystem not as easy as people think. So finding hundreds of companies and investing in them is a lot of effort. You need a lot of resources to do that. There is a number that not only us, but also, for example, 500 startups and others claim to be the right number in venture to have a diversified portfolio, which is 500. So we are also talking about those 500 companies in one portfolio, a diversified portfolio of 500 startups, in our case, across Europe. So even if you're a fund, let's say in Germany, it's very difficult for you to source companies in Romania, Estonia, Sweden, Denmark, because you will be, mainly looking at companies around Germany. So our idea and thesis is we don't think that, today a tech company can be started everywhere. It's not only Berlin and London, but for example, the biggest outlier in our portfolio comes out of Romania. Out of the first portfolio was 330 companies, and we have only 3 companies allocated in Romania. And 1 company out of those 3 companies is the biggest outlier in the total portfolio. And no one expected this company coming out of Romania. Everyone expected London, Berlin, Sweden, maybe Stockholm. But that's the thesis that we have. We don't know where the next outlier can be created. It could be Estonia, it can be Latvia, it could be any CEE country or Southern European country. As long as they are early stage, can be created everywhere. And then they move to the US or London or Berlin. That's another story.
Actually, in that sense, venture capital firms are having quite a hypocritical approach. Like they're always speaking about a business model which is scalable, and all their startups need to be scalable. But if I see it correctly, venture capital funds are not scalable. How do you see that?
So yes, it's part of our. It's the second part.
How do you choose actually then the venture capital funds you are investing in?
Yeah, so we think fund returns in venture are related to fund size. So even if you have let's say $1 billion VC fund, the average exit returns in venture capital or in technology in general is around $100 million. You have to earn your returns with $100 million, unless you have an outlier, which is sometimes several billion dollars worth. But having an outlier is relatively, seldom. It's not like happening a lot. So not all of the bigger funds will have outliers in the portfolio, and the majority of the returns will come through the $100 million exits on average. So that's why we think that fund returns in venture capital are related to fund size. Smaller funds return better fund multiples, return better returns at fund level. And we think, and that's part of our thesis, we think and believe in small funds, and that's why we are investing in small funds. Now, if you want to scale that small fund, let's say from a 20 million fund to a 200 million fund, it will become a completely different fund. It will be not a seed fund anymore. And that is the scalability issue in venture. I think for most of the smaller funds that return well, they can't scale 10x or 50x. A fund of fund, on the other hand, can scale. So we do at the moment 1 million, 2 million checks in each fund. We could easily do a 5 million or 10 million check in each fund. So in our portfolio, if we have 20 funds, that equals to 200 million. So that's the scalability on a fund of fund level, which is more difficult on a fund level.
That's quite interesting. And when you're looking into the funds, you have mentioned a little bit like the sectors or different regions you are looking at. But like, how about the characteristics of the GPs? I know you have more than 70 partners throughout your portfolio. Like, how do you select them? What make them? Yeah, what are the outstanding points that you chose those partners in those funds?
Yeah, it's a good question. Thank you. I think there is no clear answer to it. It's not like that we have 5 criteria and then we go through the 5 criteria and we have an answer how to select a GP. We are a big believer in diversity, and with diversity we not only mean like gender diversity and a diversity of nationality or background, but also background in terms of education, for example. What kind of education did the GPs have? What kind of backgrounds in terms of working experience do they have? Do they have operational technology experience? Are they investors before? Have they been angels before? Have they put own money into the game? Have they made money in the past? Have they worked for a top brand? Are they specialists within a vertical or horizontal area, for example, specialists in blockchain, specialists in biotech? So it's very, very different profiles. And coming back to what I've said in the beginning of diversification of 500 companies, we think it would be a big mistake if we would have similar GPs in our portfolio, right? So the whole idea of diversification is also in the selection of GPs. We want to have a diverse portfolio of GPs to have a diverse portfolio of companies, and that's the way how we think. So if you look at our GPs, they're probably very different from each other, but that makes the portfolio different, and that makes that's the way how we add blockchain companies, but also biotech companies, life science companies, but also AI, ML companies into our portfolio, or the simple fintech company, the next generation of fintech companies. And these are all different profiles that select those and build their own personal brand and relationships to the founders. So that's the way how we see the GP world.
Speaking of the GP world, the logical next question is, how is the LP world going? I know you have a massive interest currently in your new fund. You're launching Fund 3. Here is something I didn't mention at the beginning. The Euro Institute and Multiple Capital have finally joined forces on that project. So I know probably a lot of insights, but people around us, they definitely want to know who are the investors, the LPs looking into multiple. Can you tell us a little bit more about your typical LPs?
Yes. So the LP world is still two-sided, I would say, especially in Europe. Many LPs still don't have access to venture capital and don't have venture capital in their portfolios. So for a lot of LPs, it's still a new asset class. On the other hand, everyone and more people understand that venture capital is a new asset class that should be probably allocated from the portfolio or part of the portfolio, because it's returning quite well and it's really evolving or maturing also in Europe and globally. So I talk always about the war for talent, and I think venture capital today wins the war for talent across, or against all our other asset classes. Everyone wants to be either a founder or a VC today. 8 years ago, this was not the case. So when I started in venture capital, most of the people in my environment didn't know what I do, right? But now you have the Shark Tank kind of TV shows, and people have a better understanding of what is a startup, what is technology. And then you have great examples really becoming great companies. And then, of course, like the major newspapers write almost every day now in Germany about the startup community and startups. So this has changed completely over the last 8 years. And I think LPs have also changed and are more open to look into venture capital. But as I said in the beginning, venture is not an even game. So you can't select just one fund and invest. You really have to put resources into selection, either companies if you want to invest directly, or in funds. There are today hundreds of funds in Europe, only Europe, hundreds. So you have to do your homework. You have to meet and understand what the funds do and how they differentiate, and then select the funds that you want to invest in. Ideally in a way of building a portfolio. And what we do is we outsource more or less this part. So we can do that for an LP with the experience that we have, because we have invested already 8 years, and now today we are at 27 funds. And we have screened almost 900 funds over the last 8 years. And that's the experience that we can bring in. We have a track record, we've done it, we have a good relationship to a lot of GPs already. We get inbound deal flow now more and more from the US, because the branding of Multiple is visible. And that's another thing, if LPs want to have this visibility. So let's talk about, let's say, a family office. Most of the family offices you and me know are relatively discreet, and are not public and are not publicly visible and are not looking publicly for startups. So, or fund investments. So it's difficult to really match. It's really difficult to find for the VC and the family office to find the funds that they want to invest. And we are public, we are visible, and funds know us, and they reach out to us, or we reach out to them, and that's the way how we can build portfolios for them. Otherwise, you need, it's not impossible. Everyone can build what we built in-house, theoretically. So you need a team. You need someone who's doing the job. And ideally, you need a team that is experienced. And I think that is probably the most, let's say, rare part or difficult part at the moment in Europe. There are not a lot of people that are experienced in selecting VC funds in the European ecosystem. And yeah, we're there to help on this part.
Very interesting. But then, so you mentioned as an investor group, family offices looking into it. Then you were mentioning some other groups, but like, who are really the other groups besides the family offices looking into your type of investment class?
So the people we speak mostly are family offices, are high net worth individuals. So and high net worth individuals are, the standard I would say non-tech related high net worth individual, but also the tech entrepreneur who became quite wealthy over the time of his, let's say, exiting a company in the tech area. Some of them have hundreds of millions. If you look at Trivago founders, Skype founders, they are very, very rich today, TransferWise, etc. There are many companies where UiPATH is a great story where the founders will be very, very rich people. And they are bringing back or giving back to the ecosystem. They believe in that asset class. They believe in technology. So they are big investors today in the venture capital ecosystem in Europe, as well as they were already in the US. In the US, tech entrepreneurs are already a big part of the LP world. But next to them, corporates are more and more interested in the VC world because they want to have more insight, and they do invest as LPs next to their CVC activities if they have any, or they just do LP investments to have an insight into the market they are interested in. And then, of course, more and more typical institutional LPs or money, pension funds, endowments in Germany or in Switzerland are more and more interested on the VC part. One of the reasons is also that VC is related more and more with impact investing, be it social impact or climate-related impact investing. And many of those institutional investors, especially the family endowments, are interested in that part of business. It is sustainable in a way because we have created 20,000 jobs over the last 8 years with the investments we have done in newly created companies. So the whole social impact part, creating new jobs in relevant sectors, is really part of venture. But also, if you look at pure return levels, venture, as I said before, is really maturing when it comes to returns. So it's definitely a part of asset class that will return, or that is returning at the moment, very interesting returns. Also on a global level, if you look at European returns in venture capital, I think these are the drivers and these are the LPs that we are speaking today, where we see most interest. In the past, it was more family offices. Today, it's more and more also institutional investors that have at least interest to see how they can participate in venture capital.
You mentioned right now a very interesting company, UiPath. That type of founders are getting really wealthy. Now, truth here is, you are an investor in UiPath. Can you tell us a little bit more about your background, how you got involved in UiPath, and what that means actually for Multiple's performance?
It's not clear yet, but it's one of those companies that we are aiming to have when we invest across 500 companies. It's what we call a true super outlier company. Just to give you in numbers what that means. UiPath, we invested in a what we call local generalist, so a fund that invests in Eastern Europe, and this fund invested in a few Eastern European companies, and one of those companies was UiPath. And again, it's a tiny allocation in our portfolio. And the region, Romania, was a tiny allocation in the overall portfolio. But this single company, 5 years ago when we invested, compared to today, has made on the initial investment more than 1,000x. So the answer, like to your question, even if we would write off in that portfolio, first fund of fund, we had 330 companies. Even if we would write off the 329 companies, which we don't, right? Many of them are still very, very well performing, and we had already several exits from the rest of the portfolio. But just to make the example, even if we would write off all of them, this single company will still return more than most other asset classes for that vintage and for the period. That is what we call a true outlier in venture. This is the value markup, valuation markup that you can have if you invest early stage in a true outlier in venture. UiPath is today, it's public numbers, valued at $35 billion US. And it was a seed stage company 5 years ago. So the markup is unbelievable. And this is the kind of company that we that we are looking for. That's why we are diversifying so much, because we want to have this kind of company again in our portfolio. And the probability of having this is higher with the kind of diversification and selection that we do. We select out of 800 funds, the 20 that we think are the best, and those 20 funds invest in concentrated portfolios of 25 companies per fund, which equals to 500 companies in our portfolio. But the idea is having the next UiPath in the portfolio, be it in Cambridge, in Tallinn, Helsinki, wherever it might be. But we want to be the first investor in those outlier companies. And ideally, we have a handful or many of them, right? Statistically, you can say in venture that 1% is an outlier, okay? When we say outlier, it's like a 100x company. So 1% in 500 companies would be 5 companies, okay? But if you have one super outlier, that is like having 20 normal outliers. UiPath is today like 35 unicorns, having 35 unicorns in the portfolio. It's not like one unicorn. It's like it's a decacorn. It's a 3 times decacorn. So it's like others could say they have 35 unicorns in the portfolio. This is like the true outlier. And now we all don't know if in the next 5 to 10 years there will be another this kind of company. But everyone believes in technology. Everyone believes in what we call in Germany, the word digitalization. It is much more than digitalization, right? It is biotech, it is climate, it is blockchain. There are so many verticals that are touched with technology, and that can be huge or even much bigger than the 35 billion valuation. Now imagine if you think about the strongest companies in the US, tech companies of the last 20 years, all of them are hundreds of billions worth. Google, hundreds of billions, Apple, hundreds of billions, Facebook, hundreds of billions, Amazon, hundreds of billions. We haven't created this in Europe yet, but we have started to create 30 billion companies. And just to put it in relation, 30 billion is like 6 times more worth than a Deutsche Bank, today. So it's created within a few years, and it's worth several times a DAX company that is a traditional, very solid, huge company in the German ecosystem. Just to give you, the relation that is created here. And to your last point, we don't publish publicly the exact numbers, but to give you the answer in a different way, I think the first portfolio that we have created, the first 10 funds that we have invested in, the return of this portfolio is what we would call is probably the best fund of fund return ever produced in the European history of private equity and venture capital fund of funds. So this is
That's amazing.
Yeah, exactly. So this is the real answer to the returns. Whatever it is in the end, I think it will be huge. And we don't know if we can repeat this kind of returns, right? But we try to work on getting closer or increasing the probability of getting close to these kind of returns. That's the whole idea, the whole thesis of multiple.
That makes a lot of sense. And I know many investors are really interested in getting into that investment class for those returns. However, what is holding them often back is the liquidity. A lot of people are saying, like, when you're investing in startups and venture capital funds, your money is blocked for at least 10 years, sometimes up to 15 years. But another thing which they often don't understand is the setup of capital calls and when the money is actually really returned. Can you give us like your setup, how Multiple is doing it, and how that capital call structure works, and when you are returning also the profits out of the fund?
Yes. So let me make it very simple, because some, might never have invested in a venture or a private equity fund. So the typical way how private equity or venture capital works is that we don't get the money that is invested by the investors upfront. We call it capital commitment. So if you as an investor invest in multiple, you commit capital, let's say $1 million, to make it simple. So now this commitment is reserved, but it is still on your bank account, okay? And we pull money as needed, typically in our case per quarter. So we call something like 5% of that million every quarter, okay, in the investment period. So investment period is during those years when we or our funds are investing into startups. Typically in our case, it's around 5 years, okay, 4 to 5 years. So we call the 1 million that you have committed to our fund during these 5 years. If you compare that to a real estate, for example, you have to pay upfront to buy a house, you know, and then you get rent or whatever, and that's your return. In our case, you invest, but you don't pay upfront, but you pay in more or less installments over 5 years. Okay. After 5-6 years, roughly in the second half of the fund life, the first startups are going to be exited, so sold. As soon as a company in our portfolio is sold, the money goes back pro rata to the investor. So just to make it again simple here, and I'm not talking about some details like recycling to keep it simple, but technically we call it in the first 4-5 years in installments, like 20% each year to make it simple. And then as soon as we sell those companies after 5 years, for example, the first startups that we invested in year 1 will be matured to be sold in year 5, year 6, etc. These returns will go back to the investors. So even though the lifetime is 10 or 12 years, it doesn't mean that the capital is locked for 12 years. Typically, it's liquid way of getting capital in and then getting capital out. And because we are so diversified, we have early exits as well. Like typically, not all of the companies are waiting 5 years to be exited. Some of them will be exited in year 3 or year 4, and some of them will be exited in year 8 and year 9. But the majority of the capital plus returns plus the profit will come back in the second half, during the second half of the lifetime, between year 6 and year 12. We might still have in year 12 a few companies left in the portfolio, and that's why some funds in private equity or venture capital take sometimes longer than the original lifetime. But that does not mean that you have all your money locked in year 12. You have most of the money back by the end of the lifetime, and sometimes there are options or alternatives how to end a fund. There might be a secondary sell, in year 12 or 13 to sell the rest of the portfolio. But just to mention one thing, Alex, we talked about it. If you have an outlier in the portfolio, if you have a company like UiPATH in the portfolio, you should try not to sell too early, right? Because these outliers will return much more than people can expect from normal returns. So if you hit an outlier with our portfolio, then you should stay with the portfolio and stay with the outlier. Don't sell early, okay? And that's like the learning that we have over the last 8 years. If we hit an outlier, we recommend all our investors to stay in, even if it takes longer, because people don't understand, even if you have an early return, you have to reinvest. And reinvesting is always related to costs, resources. You have to search again for investment opportunities. Plus, you start again and you don't know. Like it's a blind pool, blind portfolio. You don't know if you hit another outlier. So if you have an outlier, please stay in the portfolio and use the momentum to create more returns. Just to give you an example, I think when Facebook did an IPO, or other tech companies today did an IPO, they were valued 10 to 20 times less than today. Okay, and people probably sold pre-IPO because they thought it's a great valuation now at a 20 billion, 30 billion valuation. Today Facebook is valued 500, 800 billion. I don't know exactly the numbers, but it's crazy how much return can be created still with outliers. So we recommended, for example, not to sell anything in UiPath. And I think we were right not to recommending to sell anything in UiPath.
Super important information, I think, for a lot of investors looking in the VC space or looking to invest in the VC space, that they actually know or understand the ways how the logic works and that there is some level of liquidity. Looking a little bit more into the present and also to the future, we have a lot of current events happening. We are in a COVID crisis. Some countries are on lockdown. On the other hand, we are having the Brexit currently happening. We have the German government on the other hand and planning to invest 10 billion with their future fund over the next couple of years, over the next 10 years. Where do you see the future of German or European VC heading? Yeah, what will the future look like of the VC space? Are there changes coming? Is the industry innovating? Is the industry changing as itself?
So let's start with the last question. I think the industry is evolving and changing constantly. Venture is a very adaptive ecosystem. New entrants, new players in venture capital are created every year. It's not like that the big brands have everything and new brands have nothing. Just to give you an example, the fund that we have invested in UiPATH is a first-time fund, first-time team, first-time region. Everything is like emerging, and they have created the best VC return ever in the European history and one of the best globally. So just showing that venture is really something about, we are investors in new things, and that's why investors are also most of the time new investors. Coming back to the general ecosystem in Europe, I think in general the whole ecosystem has improved a lot during the last years. Okay, you have a lot of new capitalists, you have a lot of new LPs in form of at the moment, a lot of government players like British Business Bank in the UK, who is more and more replacing the EIF, which has pulled out of UK because of Brexit, which was in the beginning, a perceived problem, but now BBB and private investors are coming in. And so UK investors were very successful raising their funds in the last year. So I think Brexit might have had an effect on the startups in the UK ecosystem, but less than expected, I would say. We are still allocated into UK funds. We think some of the best GPs are coming out of UK. So that's the UK part. In continental Europe, we see also a lot of initiatives on national LPs, national government, KfW in Germany. You mentioned the Future Fund. The German government has committed 10 billion euros over the next 10 years into venture capital, which is a huge amount, right? KfW will allocate, I think, most of that part, but they have also said that some of that part will go into private fund of funds, where we would, as a private fund, as one of the few, or probably the only private fund of fund currently, would benefit from this step. We would welcome that. I mean, ideally, in a perfect world, you should have private LPs only, because private LPs are the ones who will profit in the end from those returns. So we're still not there yet. Again, here, other initiatives are the European Investment Fund on a pan-European level, but also PFR in Poland, several in the Baltics and in Finland are several government institutions who back first-time VCs and emerging VCs. What we need more, and this is coming, is the private side. So we need more private capital that believes and understands that European venture is returning money, returning interesting returns. And also the 10 billion Zukunftsfonds Future Fund in Germany, the idea is to double that amount by private investors. Okay, it's not only that the government is giving 10 billion away, it's 10 billion and to generate private LPs that was doubling this amount to 20 billion. So the idea is to have 20 billion for the German ecosystem in the next 10 years. Now, I think not everything is written in stone, but one critical remark is the German government wants that money to be placed in German startups. If you are an LP, and I mentioned the Romanian startup, being the outlier in Europe. So if I would be an LP, or, I am an LP as a fund of fund, it would be not very smart to invest only in one region or only in one vertical. It's just very, very niche, and having the money, let's say you're a pension fund, I think it's not the smartest way to allocate this money only into German startups, right? So ideally you should allocate into the next winners, and that may come, those winners may come out of Sweden or any country, even any country in the world. But let's say at least on a pan-European level, you should be diversified on a pan-European level to have the right returns that you would expect from this asset class. It's more difficult to have these returns if you're allocated only in one country. So I don't know if this will be changed or if this, it's just for me, it's a no-brainer. It's a standard or it's a logical thing that private LPs should have a more diversified portfolio across countries, including UK, including continental Europe, and ideally including the US as well. So that's the.
I think that's a nice way to wrap up our conversation. Ertan, thank you so much for bringing all those interesting information, speaking with us about multiple strategy, how you ended up creating multiple, and how you have found some of those unicorns, having some of those unicorns actually in your portfolio. I know if people are interested to find out more about multiple capital, you have your website, you are also free to leave a comment here. You can follow us, you can reach out to Ertan or myself. We are always happy to answer any requests, questions, comments, whatever you want to know about the fund-of-fund space and the venture space. Any comments are welcome. Ertan, thank you again for joining us today. It was a pleasure, and I hope to see you soon, everybody, again.
Thank you very much for your time. Thank you.